Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing GoPro stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. GoPro manufactures action cameras and video editing software. The company also produces various mounting accessories for its cameras, including a 3-way mount, suction cup, chest harness, dog harness, surfing mount, and lots more. It has more than 36 million followers across all its social media platforms. The company is headquartered in San Mateo, California, and was founded in 2002. It trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Vienna, EuroTLX, Swiss, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a small cap company, 1.7 billion market cap. They're trading at $11 a share, and they have 156 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow in 18 and 19. They managed to have positive free cash flow in 2020 during COVID, and it's even better in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative each year except in the trailing 12 months. Revenue is the sales for the company, and that's pretty flat. It was down in 2020, but around 1.1 billion the other years. This is their income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was highest in the trailing 12 months at 450 million. Their gross profit margin has improved a lot because they have more gross profit in the trailing 12 months compared to 18 and 19 with less revenue. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. And below that is their operating income, which was negative in prior years, but they had a big positive in the trailing 12 months. They paid 23 million of interest on their debt, which is the most they've paid in the past few years. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. Then you have your pre-tax income, then your taxes, and then your net income. And the reason they had such a big positive in the trailing 12 months was this $280 million tax credit. In prior years, it was negative. We'll talk more about the tax credit in a little bit. This is the company's income statement from their quarterly report. The first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. Their revenue in the third quarter was 317 million, up a little from 281 million. They shipped 832,000 cameras in the third quarter of 2021, which is down from 923,000, but they're charging more per camera, 381 versus 304. That's why their margins are improving so much. Sales from its website grew from 81 million to 94 million, and then sales in retail stores like Best Buy also improved from 199 million to 222 million. 30% of their sales are from their website. And that is the highest margin because they don't have to share any of the profits with another business, like a retail store like Best Buy or Target. 70% from retail. Half their sales are in the Americas, 27% in EMA, and 22% in Asia Pacific. It's good when you could invest in a product that's able to sell all around the world. Because if one part of the world is in a recession, you could focus on the other part. Even though their revenue went up a little bit, their cost of revenue went down. So their gross profit is a lot higher than in 2020, from 99 million to 138 million. Their gross margin for the third quarter is 44%. The median in the industry is 27% and the average is 30%. So they're doing really well at becoming more profitable. This is out of 20 companies in their industry. I'll show you the list of companies later. You generally want to see revenue growth with a company. Their revenue has been flat since 2016. At least their margins are improving, but you can't improve your margins forever. Revenue could improve pretty much forever. They spent 36 million in R&D, 37 million in marketing, and 15 million in G&A. So their operating income went up a lot from 9 million to 49 million. They spent about 6 million of interest on their debt, which is up from 5.3 million. So their pre-tax income was $41 million, but their net income was $312 million because of this large tax credit of $270 million. I would just focus on operating income when I look at the income statement. That's a better indicator of how the company's doing. And they are improving their operating income, which is good. It was negative $92 million in the first 9 months of 2020. Then that went up to $55 million. They were carrying a deferred tax asset of $300 million. A deferred tax asset is a temporary difference carried on a balance sheet that will eventually help you reduce your tax bill in the future. An example is if you overpay your taxes, or in their case, a lot of it is from big losses in the past. $178 million of operating loss carryforwards. If you have losses, which is common for a startup company, although this is not a startup, but if you have losses in the early years, you can use those losses to absorb future profits, so you pay less taxes in the future. They also received $80 million of tax credit carryforwards and a bunch of other smaller items. So you could wait until you become profitable and then use the deferred tax assets. But some companies may feel they'll never become profitable and pass through a valuation allowance, which is what they did, a $287 million valuation allowance, which is not ideal. It really distorts your income statement, as we saw earlier. And then if the company becomes really profitable, like it used to be in the past, it could reverse the valuation allowance, which would once again distort their net income. This is from the company's 10Q. It says each quarter the company assesses the recoverability of its deferred tax assets. The company assesses available positive and negative evidence to estimate whether sufficient future taxable income will be generated to use its existing deferred tax asset. The company concluded it is more likely than not that its deferred tax asset will be realized, and therefore the valuation was released, which resulted in a $263 million non-cash net benefit to earnings. When they do their fourth quarter 2021 accounting, they're going to look at this again and determine if that was the correct course of action. They mentioned that down here, the income tax benefit will be remeasured. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They did have negative operating cash flow in 18 and 19, but they turned it around in 2020. They raised prices. Now they have $94 million of operating cash flow, and it's even higher in the trailing 12 months. They don't spend too much in CapEx, only a few $1,000,000 a year. CapEx is investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow, which was negative in 18 and 19, positive in 2020 and the trailing 12 months. They added debt in 2020 and the trailing 12 months. They were probably concerned they were going to lose money during COVID, so they added debt just to be safe. And they do add a few million of capital stock each year, but it's pretty irrelevant. Here's their operating cash flows from their statement of cash flows. And the way you calculate operating cash flow, you start with your net income or net loss. Then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with the $318 million of net income. We add back depreciation and amortization. We add back stock-based compensation. That valuation allowance that improved our net income, we have to minus that out. That's a non-cash item. Deferred tax assets, deferred tax liabilities, and valuation allowances are non-cash items. They're used to either increase or decrease your net income so you pay less or more taxes. A deferred tax asset will help you pay less in taxes. A deferred tax liability will result in you paying more taxes. And then we have to adjust for changes in working capital. They bought $23 million of inventory, so that's a cash outflow. But they took $11 million of inventory off their balance sheet and put it onto the income statement in 2020, so that was a cash inflow. Even though they had an accounting profit of $318 million, they only generated $65 million of cash flow. Cash flow from operations is a much better indicator of how the company's doing than net income. But if you only look at the income statement, then look at operating income, not net income. Here's their investing and financing section from their statement of cash flows, the first 9 months of 2020, the first 9 months of 2021. They spent $5 million in investments in PP&E. They bought $82 million of marketable securities. This is short-term investments, so they could earn a little interest instead of sitting on cash. So in their investing section, they had a cash outflow of $87 million. Last year was a cash inflow of $10 million. Because last year, $15 million of marketable securities matured. They raised $7 million from issuing common stock. When they give equity to their employees, they have to pay the taxes on that. They paid $15 million of taxes. So in their financing section, they had a cash outflow of $8 million. Last year was a cash outflow of $1 million. This is the equity section on their 9/30 balance sheet. They have $500 million of equity. They raised $1 billion from selling their business. They lost $300 million from running their business. They bought back $114 million worth of common stock. On 2 different occasions, they purchased 10,710 shares. Treasury stock is a contra equity account. It decreases your equity balance. Earlier, when we were talking about valuation allowance, that's a contra deferred tax asset account. It reverses out your deferred tax asset. Let's look at the capital structure. $550 million of equity, $280 million of debt. They're 66% equity, 34% debt. But they could pay off all the debt with the cash on their balance sheet and still have $94 million of cash left over. I gave them the middle whack on Finbox, 9.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2 billion. We divide that by 156 million shares. And we get a calculated stock price of $13. They're trading at $10.58, so they're trading at a 20% discount. It's a buy according to the model. Their revenue is projected to increase 4.3%, so I grew it 4.3% for the next few years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 2 free cash flow numbers and I divided by these 2 revenue numbers. That comes out to 13%. So I multiplied their future revenue estimates by 13%. That's how I got their future free cash flows. The website Simply Wall Street's at $18 a share. They're saying it's 41% undervalued. 3 analysts priced this stock and the average price target is 13. The low is 11, the high is 15. During the COVID crash, the stock got real low, down to around $2 a share it looks. But it's climbed back up to about $14. It has been regressing a little since then. But it looks like in the past 2 months, the stock is up about 10-20%. I think there was some concern for a while this company may not make it. But it seems like things are improving. Their beta is 1.09, so the stock moves with the market. It's gone up 18% in the past 52 weeks, while the S&P is up 24%. 52-week low is 7, the high is 14. And the stock is trading slightly above its 50-day and 200-day moving average. 2 to 3 million shares are traded each day on this stock. It has a high institutional ownership. 76% of the shares are held by institutions. It also has a pretty high short percentage. Almost 12% of the shares on float are shorted. When you invest in a company, it's not a good sign seeing their employee count decrease. They were close to 2,000 employees back in 2016. Now they're at 758. If you invested $10,000 into this company when it IPO'd in 2014, you'd be at $3,000 today. That's a 70% loss. There's been a good amount of insider selling and buying, but mostly selling. It seems like every quarter someone's selling shares. Here's a list of the insiders that bought and sold in the past year. The dates, their names, the shares, and the price. Everyone that sold at a lower price than it's trading at today. 62% of the company is held by institutions, 19% by the general public, and 19% by insiders. The founder and CEO owns 17% of the company. 27 million shares valued at $285 million. Vanguard is the next biggest shareholder at 7.5%, then BlackRock, Fidelity, and Prentice Capital Management. Let's look at their financial ratios. Because of that large tax credit, they have amazing price multiples, a PE of 4.5, a price to sales of 1.5, and a price to book of 3.0. Let's look at their non-current assets. 20 million of PP&E, 28 million of operating leases, 146 million of goodwill. Goodwill is the premium you pay when you acquire another company, and 280 million of other long-term assets. Here's a breakdown of their other long-term assets. 271 million of that deferred tax asset we were talking about earlier. They have a really good return on invested capital of 19%. The way you calculate this, you take your operating income times 1 minus the tax rate. So that valuation allowance is not inflating this number. So this is a true number. They can cover their interest payments 5 times. Their ROE is really high because of their inflated net income. They have a good current ratio of 1.6 and a good quick ratio of 1.3. Let's look at their current liabilities. 300 million of cash, 82 million of marketable securities, 98 million of accounts receivables. This is how much money other companies owe GoPro. 121 million of inventory and 45 million of prepaid expenses. Let's look at their current liabilities. 119 million of accounts payable. This is how much money GoPro owes other companies. 112 million of accrued expenses. 34 million of deferred revenue. This is when a company prepays for a product before GoPro delivers it. And 120 million of debt. They generated 166 million of free cash flow in the trailing 12 months, and they have 248 million of working capital. Working capital is current assets minus current liabilities. So it seems like they're well funded. They should have enough money to get through the next 12 months without needing to add any more debt. The best way to look at ratios is to compare them to companies in the same industry. There are 20 companies in the same industry as GoPro, and GoPro doesn't spend that much in CapEx, a lot less than average. Their average in debt to equity ratio. They don't pay a dividend. Their free cash flow is a lot lower than average. They're the 8th largest company in terms of market cap. They have a really good price to book ratio, better than average. Their price to earnings is much better than average because of their inflated net income. They have a really good price to free cash flow, much better than average. And their price to sales is also a lot better than average. So based off of these price multiples, you could probably ignore the price to earnings. But based off of the other price multiples, it seems like the company is trading at a good value. Their revenue is 1.1 billion, which is less than average. The average is so high because of Apple's revenue. If you sum up all the 19 companies and double it or even triple it, it's still less than Apple. Their 5-year revenue growth rate is pretty much flat, and their ROA and ROE are really high because net income is a numerator of those equations. So to summarize, I have them trading at a 20% discount, but there's more to investing in companies than doing a DCF model. Do you feel GoPro's technology will become really popular like it was? Or do you feel they may keep sliding? Because if they stay stagnant like this, it's kind of like they're declining in a way. As other companies grow and get more market share, if they're staying flat, eventually they're going to go away. I do really like my GoPro camera. I don't use it anymore. I used to use it a lot, but I'm just not sure if the company has much of a future. I could be convinced either way, but as far as investing in them, I'd probably stay away. I rank their free cash flows 5 out of 10, their revenue 7 out of 10, and their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.